Hey everyone, it's your guy here, back with a story that's absolutely rattling the global industrial order to its core. We're talking about a Chinese company that, when Indonesia suddenly flipped the script, decided to tear down a multi-billion-dollar production line, pack up every single piece of equipment, bolts, reactors, pipes, the whole damn thing, and ship it all the way back to China, a full scale, no bullshit pullout, and the power struggle underneath this, way more intense, way more dangerous, and way more revealing than what you're seeing on the surface. Now, let's be real. This isn't just some regional squabble between two Asian countries that we can afford to ignore. From where I sit as an American observer, this is a textbook case of how resource-rich nations think they can play hardball with foreign capital, and what happens when they push too far and end up shooting themselves in the foot. It's also a critical warning for every American company that has operations overseas, because if they'll do this to Chinese firms, they'll do it to us too, and they won't even blink. So let's break it down the right way, layer by layer, and figure out what the hell is really going on. What's Indonesia been up to lately? This isn't about asking for a bigger slice of profit or hiking up taxes anymore. That's small-time stuff that any reasonable government would negotiate over. No, they've got their eyes on the crown jewels, equity control, the production lines themselves, and most critically, the core smelting technology that makes the whole operation tick. Under normal circumstances, once your equipment is on the ground, your investment is sunk, and your workforce is hired, most companies would have no choice but to bend over and take it. That's the classic hostage situation in international business. And we've seen American companies get squeezed in places like Venezuela, Bolivia, and even some Middle Eastern countries over the years. But this time, the Chinese firm gave a response that's nothing short of badass. We can lose money, we can dismantle the plant, we can even walk away from the entire market. But our core technology, that stays with us, period. And from an American perspective, that's exactly the kind of backbone we respect in a business partner or a competitor. It's the kind of move that says, we know what we've got, and we're not giving it away for free today, we're digging into 3 big levels. First, exactly what tactics Indonesia used to push this company to the breaking point, and trust me, they're tactics that any American multinational should study closely. Second, why the company chose to scrap billions in hardware rather than drag things out and keep bleeding money. And let me tell you, that's a decision that would make any corporate boardroom in New York or Chicago sit up and take notes, because it goes against every conventional cost-benefit analysis you learned in business school. And third, and this is the big one for my American viewers, how any company going global, including our own Fortune 500 giants, can actually make serious money without handing over its jugular to local strongmen who think they can rewrite the rules after the checks have cleared. Let's start with Indonesia's recent moves, because they've been building up to this moment for a while. At the start of this year, right at the beginning of 2026, the Indonesian Ministry of Energy and Mineral Resources suddenly slashed the annual nickel mining quota. Just compare the numbers, because they're staggering. For 2025, the quota was 379 million tons. This year, they dropped it to somewhere between 260 million and 270 million tons. That's a cut of over 100 million tons. We're talking about a reduction that would make any commodities trader in Chicago choke on his coffee and any mining executive in Perth start making panicked phone calls. 100 million tons is not a rounding error. It's a deliberate, calculated shock to the global supply chain. The immediate effect, prices went absolutely through the roof. Domestically, nickel pig iron ex-factory prices were around 890 yuan per metric ton unit at the end of last year. Now, for my American audience, that's roughly $125 per metric ton unit using today's exchange rate of about 7.2 yuan to the dollar. By May this year, they'd shot up past 1,160 yuan, which comes to about $161 per unit. And even in July, right now, as we're talking, they're still hovering near those highs. That's nearly a 30% jump in just a few months. So who eats that skyrocketing cost? Every single company that already poured heavy money into Indonesian projects. Whether they're Chinese, American, European, or Australian, upstream raw material costs nearly doubled in local currency terms. But downstream battery and stainless steel prices can't just double overnight. The global market won't accept that. You try passing 100% cost increase to American automakers like Tesla or Ford, or to construction firms building skyscrapers in New York and Los Angeles, and they'll laugh you right out of the room and take their business elsewhere. So the squeeze falls entirely on the producers stuck in Indonesia. And here's the kicker. Indonesia is playing a game of indiscriminate harvesting. They're not just targeting China, and that's something we Americans need to pay very close attention to. Because if they do it to them, they'll do it to us in a heartbeat. Last month alone, the French mining giant Eramet, a major global player with decades of experience, and yes, a Western firm that we do business with, saw its nickel project quota in Indonesia's Weda Bay get slashed from 42 million tons to 12 million tons. That's a drop of 30 million tons, or over 70%. They couldn't handle the hit and had to suspend parts of their operations with no restart in sight as of July. So this isn't about China versus Indonesia. This is about Indonesia versus the entire world of foreign investment. That tells you the current business environment in Indonesia has deteriorated to the point where it's threatening the survival of companies worldwide. Not just Asian firms, not just Chinese firms, but established European multinationals that have been in the game for over a century. So when you look at the Chinese firm's decision to flip the table and walk away, it's exactly what any tough-minded American CEO would recognize as a strategic amputation, cutting off the limb to save the body. Because if they didn't let go of those sunk costs and kept bleeding out quarter after quarter, they'd be gambling the entire future of the company on a partner that had already shown its hand as untrustworthy. That's Business 101, whether you're in Shanghai, New York, London, or Tokyo. Now, some of you are probably asking, what's Indonesia really after? Isn't foreign investment a good thing for any developing economy? Why pull such a short-sighted, self-destructive stunt that scares away the very people who built your industry? Let's break it down in 4 words. Grabbing a free lunch with empty hands not long ago. Indonesia announced they'd gradually bring strategic commodity exports under a new state-controlled agency set to go live by September 1st. Before this, companies could mine, smelt, and then sell their metals on the global market, negotiating prices themselves with buyers in China, Japan, South Korea, Europe, and the United States. Now, the government says, nope, everything you produce has to go through our state channel. We buy it, we sell it, we set the price, and you take whatever we give you. That's a blatant power grab to take control of global pricing for a strategic commodity. And it gets even worse. Since 2025, there's been a foreign exchange rule demanding that 100% of natural resource export revenues stay parked in Indonesian banks for at least 12 months. Think about that for a second. You've built a multi-billion-dollar plant overseas. You need to repay dollar-denominated debt to your parent company. And a lot of that debt is in US dollars because that's still the global reserve currency and the only game in town for major cross-border financing. You need to settle bills with overseas suppliers, many of whom demand payment in dollars. You need to pay tens of thousands of local employees their salaries in local currency, and you need to keep enough cash on hand to handle unexpected expenses like equipment failures or regulatory fines. Cash flow is oxygen for any business. Now, the money you earn from sales has to sit idle in an Indonesian bank account for a full year before you can even touch it. That's not foreign exchange management. That's effectively seizing foreign capital to pad their own reserves and improve their balance sheet at your expense. If your cash flow gets even a little tight because of a global downturn or a supply chain hiccup, you're dead in the water. Any American CFO sitting in a corner office in Manhattan would have a heart attack just hearing that scenario laid out. So where does Indonesia get the nerve to pull this kind of stunt? Simple. They think they hold all the cards. As of July, Indonesia still accounts for over 60% of global nickel supply, and more than 90% of the nickel pig iron and ferronickel production capacity was built there with Chinese capital over the past few years. Real money, real assets, real factories on the ground. Indonesia's calculation is cynical but brutally clear. You Chinese companies have 90% of the capacity here, billions upon billions of dollars in heavy assets. Planted on our soil, that sunk cost. You can't walk away from without taking a massive loss. They figure they can tighten the screws step by step, year by year. And you'll just have to take the pain because you have no better alternative. Their ultimate ambition? Skip the decades of research and development that every developed country went through and leap straight from selling raw rocks to controlling the pricing power of new energy core materials that the entire world needs for the green transition. They want to use resource monopoly as leverage to force technology and profit transfers, a modern-day version of resource nationalism that we've seen before in other countries. And it never ends well. And let's be honest, from an American standpoint, this is the same playbook we've seen from OPEC in the 1970s, from nationalizations in South America in the 1960s, from any number of resource regimes that think geology gives them the right to dictate terms to industry. The only difference is the players in the commodity. But why didn't the Chinese company cave this time? Why take a hard hit, billions in losses, just to tear everything down and walk away? You might have heard of a term if you follow industrial technology, high pressure acid leach, or HPAL for short. A lot of the plants Chinese firms built in Indonesia are exactly these cutting-edge refineries that turn low-grade laterite or into high-purity nickel for batteries. How much does a modern HPAL project cost? Recently, comparable projects in Indonesia start at around 1.4 billion US dollars. That's 1.4 billion with a capital B. We're not talking pocket change. We're talking major league capital expenditure that would make any Wall Street investment banker break out in a sweat. And now Indonesia isn't just cutting quotas and holding foreign exchange hostage. They're demanding a controlling 51% stake in these very projects. Some mainstream media analysts over here say the factories on their turf just swallow the loss, keep 49%. And at least get some return. Better than turning it into scrap metal. Wrong, dead wrong. That analysis misses the entire point of why these projects are valuable in the first place. Let me explain this in terms any American investor or tech entrepreneur would understand. Those massive steel reactors stretching stories high and those corrosion-resistant pipes that can handle acid at high temperatures and pressures. They're just hardware shells, impressive, expensive, but ultimately replaceable. What's truly valuable are the parameter configurations in the HPL process. The exact temperature settings, pressure curves, acid concentrations, and residence times that maximize yield while minimizing costs. And even more valuable are the catalyst technologies that make the whole reaction work efficiently, stuff developed through countless hours of Chinese laboratory research over more than a decade. That's the soul of the plant. Once you surrender controlling equity, the entire management team, all technical data, every production process flow. And every operating secret are laid bare for Indonesian government teams and their local partners to copy and replicate. The competitive moat that they built over 20 years with billions in research and development funding to secure the raw materials for the new energy revolution would be exposed and stolen in an instant. That's not just a business loss, that's a strategic defeat that would affect the entire industrial chain for generations. So the company chose to smash and scrap billions in hardware rather than leave that soul behind. Because with technology, you still have leverage in future negotiations and alternative locations. Without it, you don't even get a seat at the table. And that's a lesson every American tech company should internalize deeply. Never. Ever let your crown jewels fall into the hands of a partner who sees you as a cash cow to be milked and eventually discarded. And look at the latest market picture, because the numbers tell a compelling story. In 2025, the global nickel market had a surplus of about 283,000 tons, meaning supply was ahead of demand and prices were under pressure. But this year, 2026, it's projected to flip completely to a shortage of 32,000 tons. That's a swing of over 300,000 tons in just 12 months in the coming years. High-end nickel refining capacity will face absolute supply crunch because it takes years to permit and build new HPL plants. In that macro cycle, as long as the company holds the most efficient, lowest cost purification technology. And by holds, I mean keeps it proprietary and closely guarded. It can build capacity literally anywhere else in the world that has decent infrastructure and a more stable regulatory environment. Why hang around Indonesia getting pushed around and extorted every few months? And this isn't just one company fighting alone anymore, which makes the dynamic even more interesting. Last month, the China Chamber of Commerce in Indonesia officially sent a protest letter to the Indonesian government against the royalty hikes and forex freezes. This signals a major shift to collective bargaining. If you push us all, we'll all leave together. And we'll see who blinks first when the factories go dark and the tax revenue vanishes from an American business perspective. That's the kind of united front we respect, because it shows they're not just rolling over and accepting whatever terms are thrown at them. It's the kind of solidarity that gives any negotiating team real leverage. So what's Indonesia's self-inflicted damage been from all this strong arm tactics? Because business backlash almost always hits faster and harder than politicians expect. Their grand plan was to slash quotas and restrict exports to create artificial scarcity, drive up global nickel prices, and rake in foreign exchange by selling less for more, but the market didn't play along. The London Metal Exchange nickel price did spike to 19,450 US dollars per ton in early May. That's a nice looking number on a chart, but that bubble was purely speculative and didn't hold. By early July, it had dropped back to around 16,100 US dollars per ton, erasing most of the gains. Try to force global pricing power, and global capital will just say, no thank you, and move on to other commodities or other suppliers. Even worse, without foreign capital and technology running at full capacity. Indonesia's macroeconomic picture flashed bright red. Two hard data points that any American economist would raise both eyebrows at first in May 2026. Indonesia posted a trade deficit of 1.61 billion US dollars. Trying to restrict exports to earn more foreign currency and actually ending up losing money because volumes collapsed faster than prices rose. Second, in the first quarter of this year alone, capital outflows hit 4.92 billion US dollars. Foreign investors ran for the exits faster than anyone predicted. Someone might say, but I saw official data that foreign direct investment grew 8.5% year on year in the first quarter. Folks, don't look at the past, look at expectations and forward indicators. That Q1 money came from deals that were negotiated last year or even the year before, when the investment climate looked very different. Those funds were contractually obligated and had to be wired in. But after June, with the Chinese Chamber's very public protest and real-world cases of Chinese and even French firms halting operations and walking away, not just threatening, but actually doing it, what's the global investment sentiment? By July, major international institutions, and you can bet American banks, hedge funds, and asset managers are leading the pack in these assessments, were downgrading their investment outlooks for Indonesia for the second half of the year. Today, they welcome you with open arms and a big smile. Tomorrow, when you start making money, they turn around and demand 51% of your equity and freeze all your foreign exchange earnings. This kind of short-sightedness scares off not just Chinese firms, but also European, Japanese, and Korean multinationals. And believe me, American companies in the mining and energy sectors are taking very close notes too. They all see the fragility of Indonesia's institutional credibility and the risk that their own investments could be next on the chopping block. Finally, and this is the million-dollar question for all of us, how should any company going global, whether they're Chinese, American, European, or from anywhere else, make serious money and keep their dignity intact without being held hostage by resource nationalism? I think this whole counterplay sets a fantastic example that any business school case study should analyze. Notice they didn't use state-level sanctions or military threats. That's the nuclear option between sovereign nations. Not something you play lightly in commercial disputes. They used pure global business tactics and technological innovation, directly breaking the resource holders' stranglehold on the commercial battlefield. And from an American perspective, that's exactly how free markets are supposed to work, through competition, substitution, and relentless innovation. Tactic 1, supply chain substitution. You don't sell to me at a reasonable price. I buy elsewhere. Recent customs data shows that in the first half of this year, China's nickel ore demand from the Philippines and several other Southeast Asian countries surged dramatically. Meanwhile, major domestic stainless steel mills ramped up purchases from other overseas sources in Africa and even South America. Use a massive global procurement network to dilute Indonesia's single source weight in the overall supply chain. Don't put all your eggs in one basket, the oldest and still most effective risk hedge in international trade. Any American supply chain manager would applaud that approach and recognize it as standard practice in a volatile world. Tactic 2, and this is the real killer, the game-changer end-user technology iteration. You think controlling laterite nickel gives you command of the entire new energy future. Fine. Well, just change the recipe entirely. By July this year, lithium iron phosphate batteries, which have almost zero nickel demand in the battery chemistry, have already surpassed a 65% market share in China's domestic electric vehicle battery market. That's not a niche, that's a majority. That's a knockout punch. You choke the upstream supply, we change the downstream product formulation, so we don't even need your nickel as much anymore. Through continuous research and development, we make your resource look far less indispensable than you thought. That's a technological dimension drop from China's manufacturing base. And frankly, it's the kind of disruptive innovation that American labs in Silicon Valley and Detroit should be paying very close attention to, because it shows that material science can break resource monopolies faster than any geopolitical negotiation. Tactic 3, core production capacity must remain at home. Period. Even though a lot of ores come from overseas, as of 2026, over half of global stainless steel capacity and the vast majority of new energy battery precursor manufacturing centers are still firmly rooted within China's borders. That means the final value-added steps, the ones that capture the most profit, are kept close to the research and development teams and the engineering talent. The core breakthrough logic is this: resources can be bought globally from multiple sources, but industrial standards and core technologies must be set by the companies themselves. When companies hold the world's top refining technologies, and their labs can develop next-generation batteries that sidestep certain minerals at will, they have the capability to back the next Indonesia anywhere in the world or bypass that entire country's resources entirely. At that point, they're the ones selecting global resources with their proprietary technology, not the other way around. That's power, plain and simple. That's leverage that no quota cut or currency freeze can touch. All right, that's it for today. Stay sharp, stay informed, and never let anyone take your leverage. Whether you're an investor, a business owner, or just someone who wants to understand how the world really works. I'll see you in the next one.